So just to summarize what's going on here, the authors have formulated a contingent claims model, which starts out as a fairly traditional type of contingent claims model of a Leland sort, adds to it a structural model of the trading in the secondary market. And in order to characterize a liquidity risk and a credit risk component of credit spreads and associated prices. The novelty of the paper is to allow for state-dependent liquidity risk, so that the contribution of default risk and liquidity risk is allowed to vary over the business cycle and be sensitive to business conditions. And as has been emphasized by Konstantin, allowing for interaction between those two components in a very sort of interesting way that I want to comment on. They carry out a calibration exercise which is quite successful in mimicking some important qualitative characteristics, such as, for example, liquidity component rising during a recession, as well as hitting quite a few of the selected empirical benchmarks. So it's pretty satisfactory calibration exercise in some respects. So just now a word on the motivation and what I think is the contribution here. The start of the research is really the observation, and it goes back even beyond Huang and Huang. I know it's hard for you to remember it, but there was a paper by Jones, Mason, Rosenfeld just early on talking about whether or not the Merton model is doing a decent job in trying to hit the credit spreads, and the answer was no, not really. In particular, the level is difficult to hit with plausible assumptions about bankruptcy cost and volatility, idiosyncratic volatility. And since then, there's been a lot of work on developing more sophisticated models of contingent claims, including Leland-type models, or the models that I had with Sundaresan, where you allow for strategic debt service and so forth. And you may be improving to some extent the performance of the model, but still you're missing by a wide margin some of the empirical characteristics of credit spreads. And so the candidate explanation for what is missing is liquidity, the liquidity risk. And that's the line that has been pursued here. And now, it would be simple if all we have to do is tack on just a constant liquidity spread and all the time variation being accounted for by the credit spread. But that approach doesn't do a very good job of characterizing the other aspects of the empirical distribution of the credit spreads that do vary over time. And it seems like whatever we're not explaining with credit spreads is doing something systematically over time as well. And that's basically what the research program is all about. Now, there's been some limited previous work on the modeling of liquidity in a somewhat structural way. In particular, I bring to the attention of the authors a paper by Erickson and Renault in JF in 2005, I think it was, that had something like the search friction that they introduce into this model already present. But I think it's of a static nature and not of a state-dependent nature. But it'd be useful to have a little bit more of a explicit contrast between the results here and that paper. There's also the paper that Konstantin has written with Ziguohe, which is forthcoming, which is essentially got, as I understand it, a static search friction. But basically, a lot of the methodology that is being introduced in the paper that's presented here is borrowed from that paper. Now, I think the real heart of this paper is here, okay? It's in the notion of modeling the liquidity cost. The basic story is that somebody, a holder of the bonds, starts out as a normal high type who's not liquidity constrained. He gets hit with a liquidity shock, at which time he has to start to pay a holding cost, okay? And now, what is the holding cost? The holding cost is being modeled in this equation. I think this is like a very crucial equation in the paper. It's proportional to some nominal value minus the market value for the bond. So you could think about that as a haircut, a function of the haircut. And the holding cost is this proportionality parameter, chi. So what you notice here is that we're allowing for state dependency in two ways, state dependency of the holding cost. One is the proportionality parameter is higher in recessions than in normal times, okay? The second is that the pricing of the bond is allowed to differ in recessions as in normal times, in part because of the difference in recovery rates and all the rest of it. This is a very interesting specification in my point of view. I really like this because it's capturing an important fact about the valuing of corporate bonds. This is, I think, an important characterization of essentially the funding costs of a levered holder or levered investor in corporate bonds, where typically you would fund yourself through repos on repoing out the securities, and in that way levering yourself up. And so what we're capturing here is the haircut on the repo, and then the repo rate as well. And in this way, we're allowing for what something like what Brunemeyer and others are calling the fire sale externality. Because what happens is, okay, you get hit by a liquidity shock, you now hold this. Now if we are carrying this holding cost, we'll want to dump the bond. That feeds back onto the bond price, and that increases the holding cost, and so it goes. So you're capturing what has been noticed in a lot of the characteristics in the crisis. And we see that this is being allowed to vary with the state in those two ways. So I think this is really an excellent sort of starting point. It creates a fairly complicated model to deal with, but I think it's a worthwhile thing to do. Now, a couple of comments about this. So first, what is this model good for, okay? Well, I think the real interest in this model is as a structural model of liquidity that allows for some invitation of contemplating either policy changes or market-derived changes in the way the secondary market for corporate bonds works. So in particular, the exercise that was done towards the end of the paper on liquidity provision policy that was described by Constantine briefly at the end, where you allow for example, changes in the intensity of search in the secondary market to be affected by a policy, for example, increasing the search intensity from a poor rate in the bad state to the good rate through policy action. And they interpret this as the TAF, the term auction facility. I think that's very interesting. Similar things could be done, for example, in looking at examination of the CRD implementation in Europe for the qualification for certain kinds of liquid assets under the LCR liquidity ratio under Basel provisions. Or analogously, you could also look at, for example, in the context of Europe, there's the qualification list established by the ECB on the general collateral repo. And that's going to have an impact on whether a particular bond is included or not in certain kinds of tripartite repo considerations. That's going to have an impact on on the market as described by this model. So I think that's exactly what this model is really good for. Now, other comments. The model's complicated. So Konstantin said that it's tractable in the sense that they have been able to implement this and calibrate this with undoubtedly a huge amount of work over the last year for fairly bright people working on one particular data set. I'm not sure it looks all that tractable from the point of view of, for example, a risk manager who has got to risk manage a loan portfolio of 10,000. Because you've got 29 parameters, you've got to calibrate the stochastic discount factor, you've got the firm cash flows, where we've got an aggregate Brownian shock that's going to be state dependent, we've got idiosyncratic volatility we also have to worry about. Then there's the state-dependent meeting intensities that have got to be calibrated. And the bankruptcy, Konstantin didn't even talk about bankruptcy delay feature where you're trying to not get an acceleration of cash flow because of you just have a default. So they have a Poisson process for when you receive your cash flows in bankruptcy. So it's sort of complicated. So as a result, I think there's a worry that the complexity of the model sort of overtaxes our empirical knowledge, and an empirical knowledge based on available data sets. So case in point, for example, they exclude the crisis 2008-2009 in setting the business cycle duration parameters and so forth. But because of lack of other information, they use a BIS study to essentially calibrate the CDS spread and essentially the search parameters. And use that as a normal sort of search parameter period. Well, that's precisely the period for which the market was most disturbed. Well, we just don't have, because the BIS did the survey, they were worried about what was going on in that period, but they're calibrating it, some of the things they're excluding because it's a disturbed period, and other periods they're including. So you're sort of worried about the robustness of some of the conclusions. And that would be nice to see. And the only other thing that I would say at the end, in slightly critical nature, is that they've leaned very heavily on the assumption that the CDS market is a perfectly liquid market. But in fact, empirically, it's not a perfectly liquid market. And many CDS, single name CDSs disappeared, for example, during the crisis. If you look prior to the crisis, the transaction data on the CDSs, you see a lot of stale quotes that are there for weeks on end. In trying to understand what's going on with the CDS market, some people have identified a very common component that could be interpreted as a liquidity component. That is to say, therefore, that when they try to identify the CDS spread, corporate bond spread, as identifying characteristics of the liquidity component, they're maybe not tracking the total liquidity component. And that might be the explanation for their inability to match the highly rated difference, CDS corporate bond spread. But that doesn't diminish my appreciation for the structural input that they put here that I think is really an open invitation to pursue the sort of research agenda that you were talking about, where you link this to funding and monetary policy. I think that's a really interesting framework for pursuing those sets of kinds of questions. So.
Okay.